Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. China fights back. The country ups its tariffs on U.S. goods to 125%, saying the U.S. should bear responsibility for the market turmoil. Sell America. An ominous drop in U.S. risk assets alongside the dollar and treasuries grips markets. And the first read from corporate America. The banks kick off earnings season with guidance amid the volatility in focus. Well, wow, that was a week. It's not even over yet. It's a week that's felt like a year and a year that's already felt like a decade. And Sell America continues with some pace. Look at what the euro is doing this morning. Stronger by nearly 2%. That's after the euro already gained 2.3% versus the dollar yesterday, the most since 2015. Meanwhile, the 30-year yield, little change. You do have some buying this morning, down by a basis point for both your 10s and 30s. We stand at 4.4%, 4.85 for the 30-year yield. 30-year yields yesterday seeing their biggest jump for the week if we continue at the level that it was since the 1980s, adding 13 basis points yesterday. An ominous dynamic that you're seeing, that you're more likely to see in emerging markets, not in the world's deepest and most liquid markets. Now to equities, into the red this morning after China announced that 125% tariff on U.S. equities. We have remarkably seen 5 days in a row with an intraday range of more than 6% for the S&P 500. Deutsche Bank pointing out that the only other times you've seen runs that match that is the great financial crisis in March 2020. By the way, even though we are selling off this morning, if you were to look at equities for the week, we are on track for the best week since the November election. Kind of covers up some of the craziness that we've had underneath the surface. Speaking of the craziness underneath the surface, let's get you some stocks to watch in what's already a strange session. Here with that is Bloomberg's Joe Easton. Joe.
Morning, Danny. So Tesla leading the Mag 7 lower today following those headlines around China ramping up tariffs on the US to 125%. We can see Tesla down 1.6% at the moment. It's set to be down almost 40% for the year today at the open of trading in the US. And those same headlines on China also hitting Chinese companies with the ADRs listing in New York. We have seen Alibaba trimming its gain in the last few moments. That stock was up around 4% earlier, coming back down given those trade war worries. And then back to the banks, JP Morgan and Morgan Stanley, two of the names are out today. All the focus on this volatility boosting the trading desk for equities businesses, but potentially the headlines around the impact of the tariffs going to be the main focus on the earnings call. Keep an eye on these stocks, which are slightly higher in the pre-market. And all of these moves, as usual, are wrapped up in our Before the Bell opening wrap, which is available on the terminal right now. Yeah, those analyst calls from the banks must listen to. Joe, thank you so much. Bloomberg's Joe Easton. Now, we have a great hour coming up for you. We're going to be speaking with Mark Haefele of UBS Asset Management, and later in the hour, Cayla Seder of State Street. But first, back to our top story. 125% tariffs on all U.S. goods. That is the cap, according to China, as it pushes back. Just in the last hour, it is a response to the U.S. raising levies on Chinese goods to 145%. Team coverage starts right now. Joining us is Bloomberg's Balazs Pens in Hong Kong, Kevin Whitelaw in Brussels, and Oliver Crook in Warsaw. Balazs, let me start with you. What did we hear from China just moments ago?
Well, I think it's a very strong message, and the message is that any hopes of a trade deal between the U.S. and China, or even hopes of a negotiation between Presidents Trump and Xi, have diminished even further. They had been already very dim. And what makes that crystal clear is the language that China used in the statement after the announcement. They said any further increases in U.S. tariffs is meaningless. They called the tariffs a joke. They called it a bullying tactic. And in the meantime, look at what they're doing. Diplomacy is ramping up. Spanish Prime Minister Pedro Sanchez is in Beijing right now. President Xi is planning a trip to Southeast Asia. The U.S. leaders will visit China in July. So it's almost like China is telling the U.S., we're moving on without you, with the rest of the world.
Kevin, let me bring that to you. China saying that it's now going to ignore any further moves from the White House. Is there any room for negotiation? Does the Trump put still exist with markets, again, in meltdown mode?
You know, I think everyone's trying to understand exactly where the U.S. is. And the problem is, no one really knows who they can negotiate with, who can cut a deal, and what the U.S. is actually looking for. So whether it's Europe, whether it's Japan, whether it's Vietnam, or certainly whether it's China, their first challenge is just getting people to answer their phone calls. And then their second challenge is trying to figure out, can any of them actually speak for Donald Trump? And so far, the answer really has been not really. And so ultimately, it's going to be a question of who can get into the room with Donald Trump and what is he actually looking for. The EU can't entirely figure it out. Japan can't figure it out. And it's very clear China can't either. It's not really clear to anyone whether Trump knows what he's looking for at this point, given the number of different ways he has talked about what this tariff strategy is actually all about.
Well, we have heard some clarity from Scott Bessent, whether or not the president's listening to him at this very moment. But yesterday, Oliver, Scott Bessent saying that the U.S. could approach China as a group with allies. You're there at the finance ministers meeting. Is there any appetite to work together with the U.S. against China?
I mean, I think there is great appetite to work with the U.S., but again, as Kevin is highlighting, it's very difficult to cut through for the Europeans right now. And for finance ministers assembled here in Warsaw, there's a massive task ahead. There's really three parts. There's a part of basically negotiation, retaliation, and evaluation. The negotiation part is what we've heard from everybody. They'd like to cut a deal with the United States. The question is, what can they bring, these sort of phenomenal deals to the United States that would actually cut through? They don't really know at this point. That brings us to retaliation. They're also here to create an architecture of response to the United States. That could involve targeting U.S. tech companies. That could involve taxing them. That could involve a number of different non-tariff barriers, including more tariffs against the United States. And then evaluation, Danny. They need to figure out how this is going to hit the European economy. Every finance minister I've spoken to at this point has basically no idea other than it's going to be very, very bad for the European economy. It's very hard for them to get their arms around how this is going to impact the European economy and how do they respond to that? How do they cushion that for companies and for workers? And Danny, we know that Donald Trump wants to reorder the total global trading system, the global system more broadly, but is part of his plan to have everybody move a little bit closer to China, to open up trade among other countries? Probably not. And is it certainly his ambition to basically move the markets away from U.S. haven assets into the European assets? I mean, Danny, I was just looking at the chart. Yesterday, we opened the session on the euro at 109. We've broken through 114 today. This is absolutely huge in terms of the moves. And these are the conversations I'll be having with the finance ministers here. Is Europe, is the boon to the new Treasury?
That dollar move spooking a lot of people, especially because it's coming in tandem with Treasury, something that we've seen, for example, in the financial crisis, in LTCM. Laz, if I can go back to you, I just want to reread the statement that we got from the Chinese this morning. Given that American goods are no longer marketable in China under the current tariff rates, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. Basically saying it's already so high that pushing tariff rates even higher won't make an impact. Just what level of decoupling are we already witnessing with rates given where they are, Balazs?
It's quite stunning, isn't it? It's a $700 billion trade relationship, and the Chinese message is that they see it as severed, basically. That's the only way to put it. However, let me just highlight, beyond the goods trade, there's also the services trade, which is something China seems to be thinking about more and more. We're thinking about things like travel, education, financial services, computing services, entertainment, and that's where the U.S. actually has a surplus with China, and that's where China can make the U.S. feel a little bit of pain. They already said they will limit the access of U.S. movies to the Chinese market, obviously a huge market for Hollywood. So that's one area where they might even be able to go further, even after saying they will not raise tariffs on goods.
And what is the threshold of pressure? Kevin, I come back to this with you because when we had the last Trump pivot, you can use whatever explanation you want. The bond market and volatility, JP Morgan's Diamond on Fox Business, Congress getting a bunch of complaints, or Trump just saying he's feeling the vibes and changing his mind. How do we understand what might move the White House and what pressure he's maybe getting from those he's working around right now?
I mean, I do think it's very clear the bond market was a huge driver of that pause. I think that, look, Donald Trump has always measured his success to some degree on where the stock market is. I think some of his advisors have been able to try to get him to stop worrying about the stock market, but I think that everyone was genuinely freaked out about what was happening more broadly. And there are some enormous potential implications for the economy. But so far, he is still listening to voices like Peter Navarro that are in the White House telling him, go, go, go on this strategy. And then at some point, it's going to be a question of whether the other outside voices are able to break through in ways that are going to get, change his mind about what the potential damage is, what the potential risk is. And I think ultimately where that's going to play out is prices. And he ran on the whole pledge. We're going to bring prices down. I'm going to bring prices down. I'm going to bring prices down. And obviously, this tariff thing is going to make things very expensive or create shortages and disruptions that are going to ripple throughout the U.S. economy, and particularly when it comes to goods from China, very quickly now.
Yeah, I mean, it's almost at the point, Kevin, where it's maybe we shouldn't be talking about the pass-through rate, but just whether or not goods from China will even be coming into the U.S. Balazs, Kevin, Oliver, thank you so much for joining us this morning. Really fantastic work. Again, a story that's quickly changing, and it's only 5:10 a.m. Eastern here in New York. Let's get you some other stories that are trending on the terminal this morning. The UK economy has posted the strongest growth in almost a year. Factories ramped up production ahead of U.S. tariffs. There was a shock 2.2% surge in manufacturing production. UK exports to the U.S. has now hit the highest level since late 2022. The House of Representatives passed a plan to advance President Trump's agenda to cut taxes and raise the debt limit. But conservative hardliners say that they want a final package to trim $2 trillion in spending over the next decade. ByteDance's revenue increased 29% to $155 billion in 2024, driven by TikTok's global expansion. TikTok's fate, though, still remains uncertain in the U.S. Last week, the Trump administration granted a second 75-day extension to work out a deal to split from its Chinese owner. For some reason, TikTok being the only thing that Trump is not doubling down on, like he is tariffs. All right, we're going to cover more and these markets as a dollar sell-off continues. This is Bloomberg. You're watching Bloomberg Brief on this Friday. I'm Danny Berger in New York. Let's track the moves so far this week because they have been dizzying. The 30-year yields have climbed about 46 basis points. That puts it on track for the biggest weekly climb since 1987. At the same time, the Bloomberg dollar spot has fallen more than 2%, with the team at Evercore pointing out that this is a dynamic that we usually see in emerging markets, and that the world's reserve currency almost always appreciates amid stress. This time, it's not happening. Joining us now is Mark Haefele, CIO at UBS Global Wealth Management. Mark, Evercore also pointing out that to this magnitude, it's only happened 4 other times in history, to the like of LTCM, the great financial crisis. What do you make of the dynamic and what's behind the dynamic?
Well, look, coming to you from the safety and stability of Switzerland, we're very aware of what we're seeing with the dollar. But I also think the analysis you just pointed to is instructive because you're talking about very serious, kind of beyond recession events. And I think one of the things we did learn this week is that the administration and the Fed, they are watching the Treasury yields, and they have taken some steps to avoid the worst fat tail outcomes of kind of like a global financial crisis. So that's why into something which could turn out to be a recession, we are looking at U.S. equities here, noting that into this volatility and the drawdowns that we've had, history says the performance from here should be quite strong over the next 12 months.
Mark, maybe one of the good things about you being in Switzerland is I think a lot of Americans are going to be canceling their vacations to Europe when they look at what the exchange rate is doing. So maybe you'll have more quiet streets there. You said that usually after episodes like this, you can buy U.S. risk assets. But does the behavior of what we're seeing, coupled with policy uncertainty, policy volatility coming out of the Trump administration, suggest that maybe we're moving to something that looks like peak U.S. asset ownership?
That is something that we're debating every day. And certainly we're in a period where there is some repatriation of assets home, be that to Switzerland or Japan or elsewhere. I just don't think that all of that can reverse that quickly. I do think that there's still, while we've taken off some of the downside scenarios, there's also the upside scenarios where some of the theories about, achieving deals and refocusing on U.S. growth, those things can also transpire as well. So we're really hitting it, I think, this morning after this latest round with China at kind of maximum, hopefully maximum fear, but certainly, measured on history, very high fear if you look at the VIX and the futures trading down again. So taking that step back usually matters. It could be very different this time. But again, if you dollar cost average it in this period, there will be some resolution probably before the 2026 election.
Mark, you point out a fair point that this is a market with two-way risk right now. It's not just the downside risk, especially we've seen a back and forth. Again, I pointed this out. If you just look at the close of yesterday, stocks are on track for their best week since the November election, which you wouldn't realize looking at just what markets are doing today. But this idea that we will reach agreements, that this is kind of as bad as it gets for U.S. policy with China. Do you have an understanding of what the circuit breaker is for the Trump administration? Do you look to the bond market? Do you look to the comments coming from banks when they're about to report earnings and what Jamie Dimon might say that catches President Trump's attention? How do you understand when that off-ramp kicks in?
I'm not sure, anybody who says they know is probably wrong, given some of the commentary from the president about how he even made the decisions about the pause. But, the sum of all those factors and a little bit the idea that, they've kind of punched themselves out now on the tariffs between China and the U.S., that also creates potentially another opportunity. Again, it is really high uncertainty, and we are talking to clients about other things that can get you diversified away from this. For example, I think all this uncertainty will continue to put a bid under gold. We saw the Chinese central bank continue to make their gold purchases. So, yes, take a look at what the numbers say on equities, but also continue to diversify to have the capital if we get more towards a recessionary scenario and the markets continue to fall in this uncertainty.
If we get towards that recessionary scenario, Mark, are treasuries still a haven? We're already running really big deficits in the U.S., and usually you add even more weight to that in the case of a recession. Do treasuries act differently this time around if we head towards a downturn?
Not on the shorter end. We still believe, they have been a great hedge, and we've been consistent in saying, look to the high quality bonds in the 0 to 5 year. 5 years kind of a sweet spot here, and that's likely to continue to work. I think there's of course the currency factor, and that's something that investors are going to have to consider. But that is I believe the shorter end will still be a go-to safe haven, because at some point, if all these things happen, the Fed will step in, and the market is pricing Fed rate cuts this year.
At what level do you think the Fed does step in? How bad does the dysfunction in markets, I should say, or the economy itself need to get before you see a Fed that's willing to act? Because so far the Fed speak has been one of wait and see.
Yes, well, we've been looking at this closely. I think that around the rate cuts itself, the negotiating tactics that the president has taken and the risk of inflation does make things difficult for the Fed to act immediately, say, on rate cuts. But I think when you start seeing spreads on high yield blow out and things, then the Fed can start taking liquidity measures and even just they'll start with jawboning that, they're very concerned or that they're watching things. So we haven't gotten to that point yet, but I think that we may have had the president not put the pause on.
Mark, really great to speak with you this morning. I hope for your sake and all of our sake that we get a break this weekend. I have a feeling we won't, but best of luck to you. Enjoy the rest of your Friday. Mark Haefele at UBS Global Wealth Management. Coming up, we're going to take a look at what else is making headlines around the world, including some sports for you. One of the world's best soccer players suing his former club over wages. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news. First up on the Wall Street Journal, the Supreme Court ordering the Trump administration to take steps to return a migrant who is mistakenly sent to a Salvadorian prison. The government had argued that it didn't have to do anything to remedy its error. Next up on the FT, Kylian Mbappe, the French soccer superstar, is suing his former team, Paris Saint-Germain, over 55 million euros in unpaid wages. The dispute stems from Mbappe's move to Spain's Real Madrid. And on the New York Times, the tragic sight-seeing helicopter crashing into the New York Hudson's River, which killed all 6 people on board. The crash involved the chief executive for rail infrastructure of Siemens, his wife, and 3 children. A really, really tragic incident. Our thoughts go out to all the families involved. Okay, coming up, we get back to these markets. We're going to be speaking with State Street's Cayla Seder on how to navigate a constantly changing market. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. China fights back. The country ups its tariff on U.S. goods to 125%, saying the U.S. should bear responsibility to the market turmoil. Sell America, an ominous drop in U.S. risk assets along the dollar and treasuries grips markets. And the first read from corporate America. The banks kick off earnings season with guidance amid the volatility in focus. And man, it has been some volatility, a week that's felt like a year that's felt like a decade. And the Sell America narrative continues with some pace, at least for the dollar. Look at what the euro is doing. It's off the highs of the morning, but it's still stronger by 1.7% versus the dollar. We're just below 114. It had its strongest day versus the dollar yesterday since 2015. U.S. 10-year yields and 30-year yields drop about 1 basis point for both of them. That's going to provide some relief after the stunning move we've seen higher on the long end this week, 46 basis points. It is the biggest gain since the 1980s, adding 13 basis points yesterday. And to equities, they fall into the red this morning. They had been gaining in the pre-market session before that China announcement. But here's the weird thing. If you were to look at a closing basis, we're on track for being higher on the week and the best week since November of the election. Deutsche Bank, though, pointing out we've had a remarkable 5 straight days of intraday ranges of more than 6%. The only time we've seen runs like that was in the great financial crisis in March of 2020. So I mentioned the yield climb and the dollar fall. So far this week, 30-year yields have climbed about 46 basis points. That puts it on track for the biggest weekly climb since 1987. At the same time, the Bloomberg dollar spot has fallen more than 2.5%, its worst week since November 2022. The team at Evercore pointing out that it's a dynamic you usually see in emerging markets and that the world's reserve currency almost always appreciates amid stress. This time, it is not happening. I'm pleased to say that joining us now is Cayla Seder, macro multi-asset strategist at State Street. Cayla, thank you so much for coming in. A crazy week. I'm sure it's been hard to get time off of your desk. What do you make of this dynamic? What's behind both a dollar weakening and Treasury selling off at the same time?
It's really interesting and really rare, especially because we haven't seen that dollar smile play out as much as we would expect. But, I think there's a couple things to keep in mind here. When we look at what real money investors are doing, so those longer term horizon investors, we do see some demand for fixed income. This is coming from below average positioning. And so there is room for upside there. But I think you have to ask, okay, where along the curve do you want to be? We have seen long end yields really rise. And so, we have seen consistent demand on the front end of the curve. Now, one thing I think that's also interesting to keep in mind here is when we think about cash and what is cash doing here, positioning there is around average. And so when you pair that with above average positioning in more riskier assets like equities, equities are still above average positioning, so above average exposure there. There could be more room to add to cash allocation in the short term as we ride out this volatility, because as we've seen, the market can change a lot in just 5 minutes.
I'm assuming you're mostly talking about domestic investors, because I wonder what happens to the attractiveness of treasuries for international investors if you don't have what usually is a dynamic that even if treasuries are weakening, you have a stronger dollar.
Yeah, that's such a good point. When we do look at foreign demand for U.S. assets and U.S. treasuries, that's actually decreased a little bit in our data set. Now, something else we're closely watching are the auctions. And the auctions we got this week, the 3-year is relatively weak, but 10-year, 30-year, those, longer end of the curve, the indirect demand and some signs of foreign demand looks still robust there. So there is some signs of, we do see demand there as well.
So the demand is there. The price action is maybe a little bit scary. At what point do you start to get concerned that this is something that looks like peak U.S. dollar asset ownership? And how far away are we from that moment?
That's a great question. I think one thing to keep in mind is, one thing we're able to do is we look at risk activity across all asset classes, and we create something called a behavioral risk scorecard. And what we see right now is a -6 reading. And to put that into context, the most risk averse institutional investors can be is -22. So a -6 to me says, there is risk off. However, it's not completely extreme. We did see some of this at the beginning of 2024 when we weren't getting as many Fed cuts as the market had anticipated, and concerns around the Fed having to stay higher for longer. And so what this tells me is that, there's not panic, but there is risk aversion.
How are you thinking about this earnings season and what we might hear from companies? We've already had Delta, we've already had a pre-warning from Walmart. Some keep their guidance, some completely remove them. What seems to be the playbook and how investors might react to it?
Yeah, one thing I think that is important to keep in mind is when we look at year-end guidance still looks relatively strong for overall U.S. equities. And when we think about where do we want to be from a regional perspective, U.S. still has really high quality metrics, and I think we'll see that in some of the earnings. Now, there's certainly a lot more uncertainty, and that's really hard for investors to grapple with. But I think what that means in terms of allocation within equity markets is that we want to stay in places that have high quality. And so actually what we've seen over the past week is, healthcare has seen a lot more inflows. And then we've also seen a lot less outflows out of tech. And that's come back more to neutral. And so I think this is a sign that, investors want to be in those higher quality parts of the market to kind of ride out this volatility.
Cayla, does all of this assume that we don't actually see a decoupling with China, that the tariffs don't stay at the current level that they're at? In order for some of these trends to play out, does that need to come off the boil?
We can't anticipate what President Trump is going to do and what is going to happen with the tariffs. But I do think, investors have to move their money somewhere. And so, places that stand out to me are places like software that are a bit more service driven, a bit less perhaps tariff sensitive. And when we look at, again, on our flow data, and I mentioned, tech flows are starting to improve, that's really in the software space. And so I think, there is a tariffs are in mind as we see allocations shift and adjust. And I don't think the market is necessarily willing to get ahead of this tariff risk. It's a really, as we've seen, volatile, evolving market. So we have to be nimble and be dynamic.
Well, the two-way chop has been remarkable. And look, we were talking about earnings. I thought it was really interesting. Five Below, the discount retailer yesterday, says that it's going to completely halt business with China for now. No more shipments. Any container that has been packed must be unloaded and returned, completely getting rid of China business. We've been asking the question, what does the pass-through look like? What does inflation look like? What are these retailers going to do? Are they going to pass along the price increase to consumers? Is that the wrong question? Should we almost be asking, will Chinese goods even find their way into America still?
I think that is the right question to ask, because ultimately, who's going to pay for these tariffs? You either see companies having to potentially adjust their supply chains, which is what we saw in 2018, 2019, where supply chains shifted away from China and towards places like Vietnam. And then, who is going to pay for that? Is it the consumer? And so what we see in our data already, because we're able to see inflation from a daily measurement, is in April, we're already seeing above average seasonal upside in inflation, and specifically in some of these household goods areas and some of the retail areas. And so it does look like, whether this is front loading or whether this is, actually feeling tariffs already, we do see signs that companies are looking to pass on prices in some areas.
So as this plays out, what's the haven in this market? What's the haven, especially as treasuries and the dollar look more volatile than a risk-free asset should?
On the equity side, I think there's havens in those high-quality parts of the market, places like software. There are signs that could be some places within healthcare. From an asset allocation perspective, I would be hesitant from unwinding too much equity exposure within fixed income, staying at the front end of the curve, but also keeping in mind cash can still be attractive here. If we see inflation, come back higher, it's going to be harder for the Fed to cut rates. And so what that means is the front end of the curve, like bills versus 2 years, can still stay inverted. And so that's not so bad right now.
Cayla, so great to have you on to end the week in what's been a year of a week.
Yeah, a year of a week.
Cayla, thank you so much. That is Cayla Seder of State Street. Coming up on the show, another test for stocks comes in just a few hours. JP Morgan, Morgan Stanley, all set to report. We'll have that with Sonali Basak next on your Bloomberg Brief.
Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing.
President Trump on the cost of transitioning to a new tariff regime, which, by the way, at that point, he was asked by a reporter what he thought of the market moves yesterday, saying he hadn't been looking at them, and asked Scott Bessent to take the question. He spoke to reporters after clarifying that the current tariff rate on China had risen to 145%. And then China pushed back. Barely 2 hours ago, it has announced an 125% tariff on all Chinese goods. Joining me now is Bloomberg government reporter Jonathan Tamari in Washington. Jonathan, just lay it out, the basics of where we stand on China and U.S. tariffs.
Yeah, we're having a tit for tat, an escalating war between these two countries, these two massive countries with huge numbers of consumers. And even though the President Trump has backed down on tariffs on many countries, China is a different target for him. Politically, I think there's a lot more support for things that are targeted at China. And I think you have a situation here where you have two presidents, President Trump and President Xi, who both place a premium on looking strong before their countries and not wanting to see as losing. And so it's hard to see where the off-ramp is for this particular fight.
On that note, the language from the Chinese coming out this morning, Jonathan, has been pretty remarkable. I just want to read the statement from them. Given that American goods are no longer marketable in China under the current tariff rate, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. The idea, Jonathan, being that the rates are already so high that the damage can't even get that much more extreme than it is. Are we talking about outright decoupling at this moment of the current rate that tariffs are at?
That's certainly a threat. The wild card here is that you never know exactly what President Trump is going to do. Even his aides don't necessarily know what he might do from hour to hour. And so that's really the big unpredictable part. So if this goes on for a long time, you could see a huge break between these two countries. The issue is, again, how do the markets react and how much pain is President Trump willing to absorb? Because even though he's lessened many of his other tariffs, we've still seen economic damage, at least in the first 24 to 36 hours. And so how much is he willing to absorb as he gets to his first 100 days, this is the kind of drop. When you look at polling, his poll numbers are dropping significantly. And it's the kind of thing that could hobble a presidency if it keeps going in this direction.
Right, well, Bloomberg Economics pointing out that the tariff rate, the effective tariff rate, is now higher than it was when Trump initially announced reciprocal tariffs after the pivot because of China itself. Jonathan, does it look like there is any communication at all between the Chinese and American governments? Is there any dialogue happening that might hint towards any type of negotiation, with Trump yesterday saying that he would hope that they could make a deal?
We haven't seen it so far, which doesn't necessarily mean it isn't happening, but there's not been public indications of it at this point. The administration has said that many countries have reached out, but they haven't provided a list of those people. So I think, that's something that we're still waiting to see. But right now, in public, at least, the public-facing rhetoric is completely hostile.
Jonathan, thank you so much for joining us this morning. I'm sure not the end of your coverage, even for today, even for the next few hours. Jonathan Tamari of Bloomberg Government. By the way, just want to point out, U.S. futures back into the green. What wild swings we have already seen this morning. And could they get more extreme? Because we've got some earnings to get through. J.P. Morgan, Morgan Stanley, Wells Fargo, all kicking off earnings season this morning as banks and other major companies struggle to navigate the trade war. Bloomberg's Sonali Basak has the hardest job today because she has to sort through it all. She joins us now. I mean, Sonali, what in the world might we hear from these banks?
I mean, think about the economic data we've seen. Investors take it as backward-looking information. They're going to listen to what Jamie Dimon has to say today, what Jane Fraser has to say about that path forward, because you're going to have two different things happening. One is you might have incredible revenue from the markets businesses, given the extraordinary volatility that we've seen. Now, how much juice is left in those institutional hedge fund clients after this deleveraging that we've seen? You have to remember, Danny, we came into this year with hedge fund leverage near record highs. So there has been a fair amount of deleveraging. How much more is there to go? Volatility is good until it's gapping, until it keeps investors from getting back into the markets. You're also going to be watching for loan loss provisions. I'm watching the pace of loan growth at JP Morgan to see how much demand there actually is for loans, given that interest rates have remained high.
You mentioned everybody is going to be listening to the commentary, and it was in large part, we understand, Jamie Dimon's commentary on Fox Business that got Trump to do his pivot of sorts. How free do these executives feel in actually commenting on the policy, especially if it's critical comments on the Trump administration's policy?
Obviously, there is a lot of caution, and you see it publicly, you see it privately. For example, we had a story this week about a JP Morgan employee who had a huge public display of this, where he redacted. The name of the report was called redacted, and there were literal blackouts in the report in fear of making somebody angry. Now, he didn't mention Trump by name, but you could deduce a lot of these policies were out of the Trump administration. He even cited compliance at the end of his webinar, saying that they didn't want anything to appear too one-sided. So there is a lot of balance, but you did see Jamie Dimon be very public in a way that is unusual just a few days before their earnings report to go on Fox Business and lay out just how damaging these tariffs can be. Months after, he said that the tariffs have some purpose to them as well. So this flip-flopping, clearly a level of fear, but not catastrophic amounts, but certainly stifling to the amount of business these banks are doing and their clients are doing.
Right, trying to balance it. But Sonali, we kind of get back to where we started. Do we expect just really wide ranges when it comes to their outlooks for the rest of the year? Are banks under threat, as we saw from Delta, of completely pulling outlooks for the year?
Or the flip-flopping of how they're handling this. Goldman Sachs, the recession call that they drew back right after that 90-day pause is a great example of this. I want to know how that decision was made. Were they ready to press that button the minute they saw any sort of pause, especially given we're still seeing tariffs at an elevated level? And, I think back to a conversation I had, for example, this week with Ann Walsh, the CIO of Guggenheim. She called me in a car ride while we watched. We were on the phone while the 90-day tariff was announced. And she was already trying to look at what existed before the tariffs, what existed after. You saw similarly from Mike Wilson in that regard as well. Is this year going to be as rosy as anybody wanted? Probably not. right? I mean, you've already seen so much activity stifled, but the question now is how bad it could get.
I was just thinking back to Davos and what these executives were saying then and just how different it is.
Well,
they were so confident then, and it's completely been the opposite.
Right? It's that Bank of America moment where Trump lashed out at Brian Moynihan that created this fear.
It's such a good point. Shanali, looking forward to your coverage throughout the morning. Bloomberg's Shanali Bassick, Bloomberg Open Interest co-anchor, and tune in for an interview with the Wells Fargo CFO that will happen at 3 p.m. New York time. So this week, the White House made its stance clear. President Trump wants Apple to begin building iPhones in the U.S., but the dream of American-made iPhones faces a reality test. Bloomberg's Tom McKenzie joins us now. Tom, there's been some really interesting reporting about what Apple is trying to do in the face of these tariffs. Things like shipping, 1.5 million iPhones to India. Where does Apple stand in trying to navigate the tariffs?
So they have built out capacity, Danny, in India, and they can use that to some effect. But 90%, on most estimates, about 90% of the iPhone production remains in China for the US. The idea that they can ship all of that over to the US in terms of the manufacturing capabilities, that is just such a tall order. The iPhone, for the context, of course, the iPhone is what drives more than 50% of the sales for Apple. It is the goose that lays the golden egg. But the complexity of the supply chains, the access to labor, the engineering talent, everything that's needed to produce an iPhone, the idea that you can recreate that in the US for many is just, frankly, too much of a tall order. You have cities, for example, in Zhengzhou, central China, where you have an area of that city. It's known as iPhone City, and there literally are hundreds of thousands of workers there. But they also have hospitals and schools and all the facilities to support that, dormitories as well. You'd have to think about, for example, a city like Boston, population 500,000, every single person there working on an iPhone supply chain, an iPhone production line. Is that actually what is wanted and what is needed? And then, of course, all the components that go into that, all the engineering talent. So moving that iPhone production to the US is just seems unfeasible at this point. They do produce some, of course, elements and products in the US, including the desktop in Texas. There is a counter to that, which is you can automate. And some in the Trump administration have suggested that Apple could use its cash pile, build out factories in the US and heavily automate iPhone production. But it's so complicated because they develop these on an annual basis, if not sooner than that. And so rewiring those production lines and automating them is something that China hasn't managed to do, and they would like to be able to do that. And the idea that the US could do that with their own components just also seems too much of a stretch. Dan Ives putting out a note. You flagged it this morning as well from Wedbush Securities, saying that ultimately you'll probably see iPhones having to retail for plus above $2,000 US stateside as a result of these tariffs.
Right, and will these companies like Apple be willing to commit more capital in the U.S. as their share price plummets and uncertainty becomes rife? Tom, I just want to quickly touch on Tesla, because the Bloomberg reporter saw that on their website in China, they've removed the order now option.
Yeah.
How far beyond Apple, for some of these EV makers like Tesla, do these supply chain ripples go?
Yeah, now facing those 125% tariffs, or at least they will do from tomorrow, April the 12th, from China, of course. Yeah. So Tesla produces two models in China at that factory just outside of Shanghai, the Model Y and the Model 3. They do not produce the Model S or the Model X, so those have to be imported. Now we're seeing, as you said, that on the website they've removed the Order Now button, so it seems that those are not an option, because how do you price those models with 125% tariffs? This, in the context, probably not a huge hit for Tesla in the context. They don't actually sell many of those imported cars, but the volumes have been dropping over 6 straight months in that Chinese market. BYD is a competitive challenge, and now you have the tariffs.
Tom, thank you so much. Bloomberg Daybreak Europe anchor Tom McKenzie. By the way, he mentioned that Dan Ives note. Dan Ives writing that this has created a price shock that will impact the daily lives of U.S. consumers and has ripped the hearts and lungs out of the big tech U.S. supply chain. This is Bloomberg. Get you set up for your trading day on this Friday. Bank earnings kick off. JP Morgan, Wells Fargo, Morgan Stanley before the bell. Some data, PPI numbers for March come out at 8:30. Will you even pay attention to them? And University of Michigan sentiment, that comes out at 10 a.m. A quick look at currency markets. The dollar continues its remarkable and historic weakening. Michael Hartnett over at Bank of America writing that U.S. exceptionalism is turning into U.S. repudiation, and there seems to be a global flee from U.S. assets. All right, that is it for your Bloomberg Brief. Surveillance takes things from here.